Uh, Good morning, everyone. This is Javier Rodriguez Beca, Managing Director of AERI, Spanish Association for Investor Relations. Welcome to this webinar on emerging trends during the COVID-19 crisis, review of the behavior of international proxy advisors and institutional investors. I would like to thank all of you for connecting to this webinar, that in fact is the first one we are organizing from AERI due to this weird situation we are living, and also those of you connecting to the available replay. We have some of AERI members in Spain joining, but also some guests from Portugal, Brazil, Mexico, and Chile. Special thanks to our collaborating member, Morrow Sodali, for jointly organizing this webinar and bringing as speakers to David Shammai, who is Cross-Border Director of Corporate Governance, and Eduardo Sancho, who is an Associate of Corporate Governance. Also thanks to BMO Asset Management for joining as a speaker with Kalina Lazarova, who is a Director of Responsible Investment. We will listen to their presentations. Your micros should be muted by default, but please proceed to mute it should you find it open. You can send your written questions for the Q&A session we will have at the end of the presentations by using the questions box you will find at the bottom right of your screen. This webinar platform works pretty well, but as you know, the lines have been overcharged in the last few weeks. So if for any reason you cannot access properly or you lose the connection, don't worry. Since the session is being recorded and you will be able to access the replay, and the link will be announced once it's ready. And now let's go with the session. We are going through an exceptional situation and we don't know how much longer it will be. But in the meantime, some critical corporate events are taking place, like annual general meetings or dividends payments or decisions. With this webinar, we would like to know what the market's point of view is and what the trends among institutional investors are. So, David, the screen is yours.
Thank you very much, Javier, and thank you to AERI for providing us the opportunity to speak to all the people attending this. So, yes, clearly this is unprecedented time, and as it happens, it coincided with the timing of the year where we're heading to the AGM season, and that has brought up a lot of issues for companies worldwide. This is not a specific market issue. This is something that companies internationally are facing. And so what we thought we would do is to go through a number of issues that we have come across working with our clients and assisting them in discussing those issues with institutional investors, going through some of these issues and see where things are evolving. And for that, we're going to have the perspective of proxy advisors on the one hand, companies and investors as well. And the way we thought we're going to go about it is starting, and you can see that on the slide, starting with a number of issues that are to do with our very immediate concerns to companies, because they are to do with the actual holding of the AGM and voting and how to go about that. So this is something that is of importance now. Then moving to touch on a number of issues that are more to do with the content of engagements with investors ahead of the AGM, and a number of issues are there to touch on in terms of how the mechanics and the technicalities of engaging with investors these days, and then move on to more content-related issues that are perhaps less of immediate concerns, but we believe will become more in focus in the coming months, say 3-6 months, as we go through the AGM period and outside it. So, starting with the first issue, which is the shareholder meetings, and within that, the whole debate around virtual shareholder meetings, which we've seen is unfolding. We know, and I'm going to hand over in a minute to my colleague Eduardo. We know that in a number of markets there were some calls by companies and regulators to allow more prominence to virtual meetings or hybrid meetings, which are meetings where there is a virtual dimension, but also a minimal physical dimension to the meeting. And that has happened to some extent in some markets. We've also seen some postponements, but it's interesting to observe how things are unfolding on that and what are the trends. So Eduardo, I'd hand over to you to reflect on some of the things specifically that we've seen on that.
Yes, David. Well, firstly, looking at the numbers, we foresee that in 2020 and 2021, there will be many more virtual meetings than ever before. Actually, ISS, the Global Proxy Advisors, has recently informed that as of the end of March, globally, the number of virtual-only and proxy-only meetings has already doubled the figure of the entire 2019, so it's a dramatic increase. Also, and as everyone can imagine, the crisis has made the number of cancelled or postponed meetings to reach unprecedented levels. And secondly, and regarding the reactions that we expect from institutional investors and proxy advisors, we observe that in general, virtual shareholder meetings will not be discouraged. Actually, in case you're not aware, both ISS and Glass Lewis have announced that they will not oppose to virtual shareholder meetings. Of course, they will demand issuers to make an extra effort, since they are expected to release stronger rationales explaining why the meetings have to be held virtually. And also, issuers will have to guarantee that all required means have been put in place to enable shareholders to participate. Anyways, right now, virtual shareholders meetings are expected to help avoid delays, certainty on agendas, and also increase voting participation. So the outcome seems very positive when we talk about virtual shareholders meetings. We've had a few problems with the connectivity here in this webinar. I'm not sure if Kalina, representing BMO, is online right now. Kalina, are you there? All right, it seems she's not there. I guess we shall move to the next slide, David.
Sure. So the next slide, Eduardo. Thank you very much for that overview on the virtual meetings and the trends on that. Thinking about the actual voting process and the custodians and the role of institutional investors, maybe a few words about that.
Yes, sure. As you can imagine, we are noticing that many agendas have been amended and many shareholders meetings have been changed from physical to virtual, while others have been directly postponed or cancelled. This implies that during these moments, both custodians and institutional investors have to remain much more vigilant than before, not to overlook unexpected eventualities such as agenda additions, shareholder items, proxy fights, or even changes in the form of shareholders meetings. Nonetheless, for a moment, what we are saying is that in general, both custodian and institutional investors have been reactive, and the overall voting process keeps working fine. Actually, the existing problems are rather in connection with the physical delivery and reception of the proxy cards, which is getting delayed more than in previous proxy seasons. But so far, that's the only sport. Finally, in this chapter, one of the main concerns concentrates on retail shareholders. A few questions are raising. Are retail shareholders correctly prepared to participate in AGMs that are going to occur nowadays with this crisis? Do they know about the new ways to participate as shareholders meetings remotely? Are they informed about all those changes that we have mentioned before? that's the bigger questions that somehow we're foreseeing.
Do we have Kalina? Seems that she is on the line.
Oh,
but for some reason is muted. So
she does not show in the attendee list. I've asked.
all right, then I think if she's, maybe we can move to the next slide, David.
sure.
Hello, this is Kalina.
Oh, excellent. Hi, Kalina. Thank you very much for joining us.
Hello, and apologies for the connectivity issue. I think you're able to hear me via the webinar, but I can hear you via the phone.
Yes, we can hear you well.
Thank you for the opportunity to bring the investor perspective on this, and I'll be very brief because I understand that obviously with the connectivity there was an issue here. Just wanted to very quickly highlight the investor perspective on virtual meetings. This is something that we have, of course, welcomed, where we have seen governments adapt legislation to allow companies to hold valid meetings, which would allow them to have dividends approved and share issuance authorities ratified by investors as well. We, of course, as we look at longer term trends and unintended consequences of any changes really that are made to the AGM structure and the way AGMs are conducted, going forward in future years, when we're hopefully out of this difficult situation, we will expect that companies continue to provide the ability to investors to participate in live meetings. For many investors, this is the only opportunity to stand face to face with board directors, and also it's a very valuable opportunity to institutional investors who otherwise do have the ability to engage with companies to raise questions in this very public arena. And this is something that investors, for example, on the issue of climate change have availed themselves of quite effectively over the years.
Thank you. Thank you. And actually, on the point about sending virtual questions, I'm just reminded that the web platform that we're using includes a facility to submit your questions. Please feel free to type them and send them along as we go through, and we'll try to answer to the best that we can throughout or once we finish the presentation. So moving on to the topic of board, and of course one of the things that happened at the moment to do with the crisis is that a lot of companies have been thrown into an operational crisis and or business difficulties, and that has highlighted the role of the board in managing risks and in overseeing the business of the company in times where risks are materializing. And clearly, from a corporate governance perspective, the role of the board is something that is central and has been central for a while. So the question that we're seeing that are now unfolding and becoming and discussed between companies and shareholders are increasingly to do with the effectiveness of the board. And we do think that this is something that we're going to continue and see in the coming months. So Eduardo, what specifically do we see in terms of companies and shareholders and the role of the board?
Yeah, here actually I would say that the outcome of our analysis turns around two main concepts, which are first board diversity, and secondly directors' external commitments. Regarding the first concept, board diversity, it's sad to say, but given the larger impact of the pandemic on elderly individuals, it is likely that boards with a high age average may suffer in a more significant way the consequences of the virus. In this case, this may lead to either much lower attendance levels than desired or unwanted changes of board composition. On the second concept, external commitments, given that board duties are expected to be much more demanding at these difficult moments, it's also foreseen that those directors holding a significant number of external directorships may be overcommitted. This obviously goes to the detriment of their reactiveness and their involvement in board issues that, as we said, are increasing during these times. Also, our observations lead us to expect the following reactions by institutional investors and proxy advisors. Firstly, we believe that they may feel much more entitled to criticize the errors made in the past when configuring boards. Actually, it is expected that any change in the composition of the board is at any rate closely monitored, but mainly if it comes from previous poor governance strategies. Secondly, as a consequence, the performance of the nomination committee may be severely evaluated if it led to failing board compositions. Also, boards of directors are expected to update and issue new long-term strategic plans and post-crisis solutions. This will give certainty about the crisis. And we particularly observe that the performance of the CEO navigating the crisis will be particularly scrutinized. And also, briefly on technology, we are suffering certain technology problems nowadays, but anyway, we believe that it's unlikely that any connectivity problem is accepted as an okay factor to explain poor board performance to investors and proxy advisors. In this case, technology shall not be a problem or an excuse. And in the end, the final message here on board effectiveness is that we foresee that well-governed issuers should benefit from their good governance practices to navigate companies in these moments. And as a consequence, they will get more easily the support of institutional investors. Kalina, what could you tell us here on board effectiveness from your point of view?
Thank you, Eduardo. You highlighted many of the areas that are very salient for investors as well. On the point of diversity, which you mentioned first, this is an area where we place an ongoing focus. For the last few years, we have engaged extensively with our investee companies on this issue. This year, we absolutely recognize that it may be the case that some plans that companies had put in place to recruit, to add new directors to the board may be scuppered by this situation. What will be very, very important for us as investors is the way in which companies communicate what plans they had in place and the extent to which they might need to be put on hold, but also crucially how they plan to evolve those plans in the future. So even if companies fall short of our specific expectations about ratios of male versus female board members, for example, we are flexible this year because we understand that it might be difficult to put in place plans that a company is expected to be able to put in place. However, the explanation around why this is happening is going to be key. And the quality of explanation is something really that I wanted to focus on here. So where companies are putting on hold plans to do, for example, with sustainability issues, that needs to be very clearly articulated, because in the future, next year or in 2 years' time, the judgments that directors have made and the decisions that they have taken about how to address long-term strategic issues are going to be in focus, and certainly going to be something that investors also build into their considerations about how they vote on the re-election of directors.
Kalina, I wanted to ask, you mentioned here the quality of the explanation to investors, and that is something that's sort of recurring as a theme on a number of points I discussed. Could you tell us a little bit, how do you approach in terms of assessing of the quality, but I'm talking about the sort of the way of discussing with companies. Is that based on what companies write in their reports? Are you looking for specific disclosure on website, or is that something that you do when you meet the company and engage with them directly, which I understand, of course, you continue to do these days as well?
Absolutely, and we've continued to have many engagements with companies ahead of their AGMs, in particular, given the time of year that we're in, we look at everything. We look at public disclosure, and of course, for the companies where we have significant holdings, or for a specific reason, we do have a conversation. This is incredibly valuable. But of course, as a global investor, and we vote at approximately 10,000 meetings in a given year, we're not going to be able to have conversations with all of those companies, and therefore public disclosure either on the website or in the annual report is going to be very important, not just for us, but for other investors as well. And this is the information that Proxy advisors will then also be able to pick up and build into their research, which investors use as one element to inform their judgments as well.
Interesting, thank you. And Eduardo, a question, or perhaps we can take us a little bit further. You mentioned the board duties will become more demanding, and we know that there's at the moment some pressure on companies. Well, boards are in constant need to refresh and renew, but that could be an issue at this moment. To what extent do you think that's going to be? To what extent do you think we'll have to see appointments being put on hold, or perhaps just searches put on hold? Or is that something that perhaps because we're talking about longer terms processes will be less of an issue?
Well, of course, if those changes in board composition are sudden, the reason is that unexpected events that happen, well, sad day, but disease, or even the death of directors. I think all investors will understand, and if the appointment processes have to wait a little bit because of the current situation we're living, most likely investors and proxy advisors will understand. However, issuers shall make an effort to disclose, to give explanations, to at least explain the moments that they are going through, if it's a tough moment, if an appointment has to wait because of the current situation. So, as we will say, after in times of crisis, information and disclosure, transparency is the key. Of course, also investors will expect that companies have plans on succession plans, on emergencies. Actually, many often boards have to have these type of plans to overcome a moment of crisis, and this will also have, I mean, issuers, they will also show that there's a certain level of planning, and that this situation is not completely a surprise, and that they have certain plans. So I think that strong rationales on whatever the situation is may help to make proxy advisors and institutional investors to understand the situation of the company, even if that translates into postponing the reappointment or the refreshment of the board.
If I may make a very quick remark on this point, this is very important indeed for investors, and we do see companies who approach succession planning very seriously. Indeed, they sometimes look 3 years out to identify new candidates that they could bring on the board, with the view, bearing in mind the evolving needs of the board and the mix of skills and experience required. And there are others where these types of plans aren't in place, and we're really seeing in conversation with these different companies at the moment how important it is to have a long-standing plan, not just in terms of ensuring levels of diversity, but also making sure that those directors who perhaps have additional commitments are not overstretched, and there's sufficient number of others with the right competence to really make quality decisions.
Indeed. And that's actually quite interesting that actually the discussions are sort of similar and similar framework to the discussions we had previously, but with a particular emphasis. And I think that's similar to what we're seeing on the next topic that we thought to bring up, which is the first of a number topics to do with content, and this is about executive pay and the compensation, the pay adjustments that we're seeing at the moment. And just a bit of background on that. I mean, we do an annual survey at Morrow Sodali. We do an annual survey on views of institutional investors on a variety of themes to do with shareholder meetings. And it's an international survey, so it reflects views of investors around the world and to do with companies around the world. And pay always comes up as a fairly high up on the agenda. And this year was no exception. I mean, the survey was published recently, but just before the COVID situation started to dominate. So it really reflects the attitudes as we were going into the current situation. And one of the things that we asked investors is what sort of things are an issue for you, could be a controversial issue for you when you vote for pay. And all the respondents, 100% of them said, well, it's about the alignment of pay and performance. And clearly now, with what we've seen in the markets over the last few years, the question of alignment is something that's going to be looked at very carefully. So that's one thing that I'd like to sort of mention as a theme. The second point, interestingly, lower down the issues that investors raised, but still at a relatively high 43% of the respondents said that is important, was the level of pay, the quantum of pay levels. Now, this is interesting because a few years back, I think that percentage would have been a lot lower because investors were focusing more on alignment and hardly at all on actual level of pay. But again, looking at what we are seeing now and the wider implications to societies and to economies of that crisis, and I think pay levels are going to become very much in the focus of the discussion. So with these two things in mind, Eduardo, what are the specific issues that we see around pay at the moment?
Yes, David. In fact, we are observing a very significant number of statements released by issuers where they announce adjustments of their existing compensation plans and their poor performance context. These adjustments are good in many directions. Some may propose to increase current pay levels to retain talent, not many. Many others will propose and are proposing meaningful decreases in executive compensation, and the rest will just opt for making no changes at all. In any case, whatever the decision is, institutional investors and proxy advisors will be expecting from issuers to provide stronger rationales than usual. Actually, the needs of information will not only surround technicalities such as repricing, dilution levels, bond rates, target adjustments, changes in vesting periods, bonus caps, etc., but also investors will want to know more specific insights, for instance, on the level of discretion of the board when adjusting compensation plan. In the end, we presume that it's a bad time for bad descriptions and poor disclosures. As I said before, in moments of change, uncertainty, even crisis, Transparency, once again, is the key, and investors, they always want to know beforehand, but in this particular time, they will want to know for real beforehand, and they will want to know all the explanations and all the justifications that lead to any change or any decision. Anyways, this being said, the conclusion of our analysis is that investors' decision and compensation will consider dividends and employment together. It's very, very unlikely that investors receive in good terms an executive pay raise if dividends have been waived or the company is losing its human capital. Indeed, we foresee that it may even open a door for shareholder activism or litigation. And for instance, just to add some color, and as possibly most of the attendees already know, in Europe, upon the advice of some European authorities, several banks and insurance companies, I'm thinking about Santander in Spain or AXA in France, they have already started to cancel dividend programs at the same time that began to reduce executive compensation. In other words, what we witness here is that shareholder management are somehow sharing the negative consequences of the crisis, and that is the general trend, the general tacit deal. Kalina, what could you tell us on this from your experience so far?
Well, yes, from our perspective, I can generally say that we would certainly not look favorably on executives receiving generous bonuses, and that's more relevant for next year's votes potentially, but at companies where shareholders have lost out, even though obviously the impacts of the virus are outside of the company's control. We absolutely recognize that remuneration committees may make adjustments to schemes to permit rewards to executives who demonstrate exceptional skill in navigating the company through the difficult period ahead. But we will pay close attention to individual company circumstances, including at whether companies are consistent in their treatment of staff and executives. For example, if companies have made it difficult for workers to self-quarantine, we saw examples of this in the early days of lockdowns in some countries, even in head offices where remote working is absolutely possible, or where they don't enforce proper safety measures at operational facilities. We would look extremely unfavorably at any attempts to compensate executives for lost bonuses. For companies seeing exceptional increases in demand for their services as a consequence of the virus, for example, delivery businesses, and also who benefit of government measures, we generally expect remuneration committees to treat this as windfall and be prepared to adjust pay downwards if appropriate. And that's something that is relevant this year for pay policies that we come to vote on. We will scrutinize them to see whether downward discretion is available to remuneration committees, whereby outcomes of the formula algorithm that arrives at the final figure for executives can be adjusted by remuneration committees in line with what is happening in society generally, as well as what is happening to investor returns. And one of the important issues. Sorry, yes, David.
No, go ahead. Sorry, go ahead.
Just one final point that I wanted to make on share rewards that are an annual feature of executive pay plans in many markets. I think it's going to be very important for remuneration committees to look at those, and in the context of depressed share prices, adjust these so that in future years, in 3 or 5 years' time, when these awards vest and when share prices have recovered, there isn't a disproportionate benefit that executives reap as a result of the situation that we find ourselves in.
So, Kalina, what I wanted to ask you, you mentioned the issue of discretion and the scrutiny of discretion. And of course, one of the ironies or one of the features of the situation at the moment, almost by definition, because it is so exceptional, is that there's going to be more need for remuneration committees to exercise a level of discretion, simply because there's going to be a lot of eventualities that were just not thought through at the time where the plan was approved, or at the time where performance measures were set, etc. And so on the one hand, you have remuneration committees having to exercise discretion more frequently or more extensively than otherwise they would have liked to do. On the other hand, you have the investors, as you explained, scrutinizing this exercise of discretion a lot more closely. How, maybe you can share with us, how do you intend to scrutinize the discretion, or perhaps put it another way, do you have any tips or any advice to companies, to remuneration committees, where they put forward to the investors or explaining a decision? How should they go about it in a way that will meet your expectation on scrutinizing those decisions?
Yes, I mean, I guess we're talking about remuneration committees exercising downward discretion and reducing awards. So I guess the ability of companies to do that already shows investors that there's a level of independence that the remuneration committees have to make unpopular, to make decisions that won't be popular with management. Similarly, of course, we're seeing management teams lead the way in proactively cutting their pay, sometimes including cutting their own base salaries down to zero. And while investors would not require such a move, we expect that companies where management or boards make these types of gestures in extreme circumstances, this is likely to maybe engender greater staff loyalty and possibly customer loyalty in the long term, where this is known. So we will rely quite heavily on the information that is available in annual reports, as we will, as we discussed earlier, of course, on the information that we glean through engagement.
Yeah, no, that's interesting. So it's again the combination of engagement and disclosure. I guess another topic, and we shall move on to the next topic, but we touched on it already, Eduardo. You mentioned that is the issue of capital and dividends, which I guess is another distribution that the company is making to its shareholders. And we have seen so far a number of companies taking some steps around that. Maybe you want to talk us through the details of that?
Yes, everything in one word, in one sentence, everything will turn around having more cash resources. And actually, we're already observing a clear trend, which is that most issuers are opting for putting on hold the stock-related programs that could need a significant amount of cash. In other words, issuers are pausing share repurchase plans and dividend programs. Also, in the same line, we believe that the surge of liquidity will make issuers to propose a greater number of capital increases and issuances of convertible and non-convertible debt pools. Additionally, institutional investors and proxy advisors will be asking for extra levels of transparency, like we already spoke in the previous slides. And those extra levels of transparency, what they try to find is making sure that the way those funds will be used. In the end, investors will want any capital increase will not be financial executive bonus or plans, as we just mentioned in the previous slide, and also mentioned. Investors would want to know the exact use of those resources to give their green light to whatever item that goes in this direction. Also, in exchange of issuers' efforts, we foresee that a relevant number of institutional investors may be a little bit more flexible on decisions that may have dilutive impacts. For instance, some of them, not all of them, but maybe some more understanding regarding the portion of preemptive rights that may be waived in a capital increase authorization, which in general terms in Europe at this level, 10% is considered the limit to accept the cancellation of shareholder rights in capital increases and issuance of convertible. Finally, and as anticipated before, I know it's not the first time we stress this, but it's likely that shareholders accept a reduction or cancellation of dividend programs only if these are preceded by significant reductions of executive and board pay. Again, the truth is that we are noticing a tacit deal that implies that both management and shareholders shall share the losses attached to this crisis. Kalina, can you add any more color on this on your side?
Hello, sorry, I've just been reconnected, apologies. Yeah, I very much agree with the last part of what you said, Eduardo. I think investors will find it important to support businesses who require emergency funding. But equally, we are seeing in the context of relaxed rules, most recently we've seen an example in the UK, where the preemption group came up with a statement relaxing the threshold for capital issuances. We're already seeing companies that do not necessarily require emergency funding seeking to avail themselves of the opportunities to raise more cash than they normally would, rather than coming to investors first, or indeed seeking greater levels of capital on a preemptive basis than they would normally do in instances where we don't feel that this is justified. So again, we will look at these extraordinary requests on a case-by-case basis.
Okay, interesting. Interesting. And on the next sort of a couple of them, just conscious of time, we'd like to move on perhaps to a question and answer once we finish that. But a couple of areas that we think we're going to become more and more in the focus in the coming months, perhaps not immediate, is first the issue of mergers and acquisitions and activism. So the initial financial shock has caused a lot of deals globally to be either put on hold or slow down significantly. There are issues to do with more difficult. It's just more difficult at the moment for investors to calculate valuations, to estimate given the operational uncertainties. I suspect that is one of the reasons behind that. And in markets where we are normally seeing high levels of activisms, again, we're seeing a much reduced level in terms of new campaigns. So I wonder, Eduardo, where do we see that heading?
Yes, well, firstly, as everyone can imagine, and you yourself mentioned, it's difficult not to refer to the consequences of the last global financial crisis of 2008. As a result, it's likely to see an increase in incidence of M&As and activism. This may come actually from different reasons like opportunism, pure survival reasons, the chances to have access to expensive debt, or the level of firepower in hands of private equity firms and even issuers. However, we also expect that these movements to crystallize once the market conditions become more stable. And also, as natural as you can obviously expect, issuers and their performing peers are more likely to be under M&A and activism tension. In consequence, we believe that, and also as Kalina mentioned before, they continue, particularly BMO continues to engage with boards and issuers ahead of their AGMs. And actually it makes a lot of sense, because we believe that boards shall remain vigilant and maintain an ongoing relationship with their long-term investors, not only on their day-to-day business, but also on this movement, activities that may lead to long-term situations such as M&A or activisms that may crystallize and materialize in some time. We believe that government roadshows, engagement programs, right now are more important than ever. I don't know, Kalina, do you have any?
Yes, I very much agree with that. Just one comment, perhaps doesn't fit nicely under this heading, but just wanted to mention that shareholder resolutions on ESG topics we don't see any dip in those, primarily because those would have had to have been submitted before most countries went into lockdown. So we expect similar levels, and in fact increased levels of environmental and social related resolutions on company agendas, particularly in North American markets.
All right, actually, we will speak in the next slide, right, about shareholder proposal and ESG.
On that, actually, to follow that up, Kalina, so you're expecting to see where shareholder proposals on ESG, of course, have been in the pipeline and submitted, so that's going to go ahead. But mainly, we're thinking the US here, and perhaps some other markets where this is a common thing. But more broadly on ESG, where do you see that evolving from investors' perspective? There was a lot of talk last year, especially, we would say has been a watershed year where clearly ESG themes have gone into the mainstream, notably climate change, but a number of other issues as well. Do you see that now continuing as is, or how would you predict things will evolve?
I absolutely think it will continue. There may be a short-term dip in activity, but longer-term institutional investors who perhaps have not been themselves active in filing or co-filing shareholder resolutions will likely undertake more of this activity, as they see pressure from their clients to be more proactive in that sense, and also from stewardship codes in many markets that are coming to expect this type of activity from large institutions as well.
And Eduardo, but maybe just to give you the opportunity, because we have here on the slide the market reactions that we're thinking in terms of different types of resolutions. Maybe you want to elaborate on that?
Yes, briefly. In the end, both shareholder proposal and ESG from the side of shareholders and from the side of issuers will have to reassess and be understanding with the new reality, the new normal. Shareholders will have to consider the new circumstances and constraints, but also issuers shall not understand this crisis as an opportunity to forget about ESG on shareholder proposal side. So there should be a new balance, but where everyone can more or less agree with that, just moving toward opportunistic directions for many of both sides. I believe that the scrutiny of investors will go in two directions. On one side, shareholder proposals intending to undertake resource-intensive actions will have an extra layer of scrutiny. But on the other side, as already referred, issuers trying to withdraw these ESG initiatives with the excuse of the crisis would also receive an extra level of by shareholders, institutional investors, and proxy classes. And finally, on the pure involvement of shareholders, we believe that both investors and proxy advisors, as already referred in the first slide, they will be very, very careful in evaluating whether all necessary means have been made available to ease shareholder participation. Virtual shareholder meetings, proxy-only meetings shall not become, just a missing meeting. That's something that shareholders, investors, proxy advisors will be also looking carefully. And that's pretty much everything we had to say on this area, David.
Thank you. I just maybe just to Kalina, to give Kalina the opportunity to on that point that you started to say that we will see more of that. But I mean, we've seen a letter from one investor. I'm talking about State Street, setting out their view on how ESG is going to be modified. From your perspective at BMO, I mean, do you expect companies to approach ESG in the same way as before, or are there going to be modifications, for example, more emphasis on issues such as supply chains or human capital management? Do you expect companies to articulate to you a modified materiality? How do you go about it? And I appreciate this is an extremely broad question, Kalina, so apologies, but anything you can give the I think the audience by way of an indication where you think things are heading will be extremely helpful.
Yes, of course. I'm sorry I skipped ahead earlier, but very briefly, I do think that companies' approaches to the workforce, as you say, human capital management, will be a lot more in focus. Just treatment of the workforce, and there will be something that also investors will now focus their attention to a lot more, given what is currently happening. We recently published a statement of expectation on social practices that is not related to COVID, but we set out clearly our expectations of how we believe companies ought to act vis-a-vis their workforce and their suppliers, and this is something certainly that we will be scrutinizing a lot more closely, and we do actually expect companies to proactively be articulating their practices to investors. We're already seeing some examples of that.
Interesting. Okay. Thank you. In the meantime, we've been getting questions from the audience, and the first question, I suspect, Kalina, this is a question to you, but Eduardo, maybe you have anything to add to that. It's about pay and compensation, and the question is, what if the company and the executives have reduced significantly their fixed remuneration, but this crisis has impact on several LTIPs? Is there anything that could be seen as balanced to isolate the impact on management without diluting shareholders?
Yes, we have seen some examples of that, and in the context of annual equity grants and the incentive plans, for example, obviously we recognize that those for 2020 or targets for 2020 will be hit, and it will be very difficult to set performance targets for any awards made during this year for the future. We, as I believe I mentioned earlier, we will look very closely at how companies are treating this, and it's something that we'll probably have to continue to be very vigilant about in future years, to ensure indeed that there are no kind of windfalls after a period that included this period of significant dip in performance. Okay.
Thank you. And we have here another question, and I do appreciate we're coming up to the end of our time, but we do have another question here. do you expect, it's a question regarding dividends, do you expect that those issuers that cancelled or are planning to cancel the dividend to commit already to pay an extraordinary dividend? And this is in light of the expectation that post-crisis favorable economic situation to compensate shareholders?
Yeah, I think this will be very different for different businesses. It's difficult to say now what companies would be able to afford at the time. Obviously, there's legislation urges from governments for banks not to pay dividends. Whether those would need to then be covered on an extraordinary basis, we'll have to see. At the moment, as a business, we don't have specific expectations in this regard.
Okay, thank you. I believe we are coming up to the end of the time. I'll let anyone who is on the line, Eduardo, Kalina, or Javier, to add anything if there is anything to add. But if not, I will say thank you to everybody. Thank you to Eduardo, and thank you very much to Kalina for joining us. I hope you found this session useful. No doubt things will continue to unfold. It's one of the characteristics of this situation. It changes almost on a day-by-day basis. But for now, I'd like to thank you for joining us, and thank you to AERI for hosting us on this. Goodbye.
Thank you. Goodbye.
Thank you.